By now, you're probably sick of hearing about Trump tariffs. However, we can't avoid the fact that it has caused fresh panic. There's flip-flopping all the time. No one knows what's going to happen for sure, but there's certainly a lot of headlines everywhere about potential recession, either soon or later because of these tariffs, and it does seem that there's fresh news every day. Even for those who have committed to a straightforward index and chill strategy, seeing your portfolio's value suddenly plummet can feel gut-wrenching. It's moments like these when investing becomes genuinely challenging, when the theory of long-term investing meets the reality of market downturns. But before you rush to cash out or bury your money in gold, let's slow down and think rationally. Every market crash teaches valuable lessons, and today's video will show why this turbulence isn't nearly as scary as it may first seem. We'll take a look at what's happening, compare it to past market shocks, reveal why trying to outsmart the market rarely pays off, and discuss how with a little bit of perspective, you can be confident to weather out market dips, crashes, corrections, whatever it turns out to be. Because despite all the noise, investing success often comes down to understanding history, controlling your emotions, and staying disciplined. Let's start by unpacking the recent developments that have been shaking the markets. It all started on the 2nd of April when Trump came out of his board on so-called Liberation Day. A sweeping 10% baseline tariff was announced alongside very high reciprocal tariff on what Trump deemed the worst offenders to do with trade deficits that he'd calculated, or just generally for countries that he believed had been treating the US unfairly. This announcement triggered immediate volatility in the global markets, and in response, Trump did end up pausing most of the higher tariffs with the exception of China. The 10% baseline tariffs were still in place, it was the higher reciprocal tariffs that were temporarily paused or rescinded. Although removing the higher rate tariffs could be seen as a good thing, this constant flip-flopping and uncertainty is also not good for the markets because no one knows what Trump is going to do next. And taking us up until present day at the time of recording, there's now a pause on the higher tariffs from China and the US for smartphones and some semiconductor components. That has led to the market recovering a little bit. So we're nowhere near the bottom of this recent crash, correction, dip, whatever you want to call it. We have seen a bit of a recovery. But with all the uncertainty around tariffs, who knows? This could very easily be undone and we might come down again. So regardless of what's happened by the time you're watching this video, the message is still very relevant. Turning to look at the year-to-date performance of various markets, the S&P 500 is down approximately 7.8% year-to-date. So although it has felt pretty painful, 7.8% year-to-date isn't too bad in the grand scheme of things. The FTSE 100 has been relatively stable with a slight decline of about minus 1.5% year-to-date. So certainly not a crash in the UK stock market. And then the European index, the Euro Stoxx 600, has on a similar note seen a modest decline of around minus 2% year-to-date. So there has been some resilience in the European markets as well. However, given that US equities constitute around 60 to 70% of a typical global fund, any significant movement in the US market has likely had a significant impact on your portfolio because most people tend to have a US till or a global fund. So if the US stock market goes down, given how much of a large weighting it has in the global fund, you've probably felt it. And for UK investors, there's an additional layer to consider. And the decline here has been worse because of this one factor, currency exchange rate. The British pound has strengthened around 5% against the dollar since the beginning of the year. This means that GBP-denominated ETFs have experienced a more pronounced decline than a standard US dollar S&P 500 ETF. With this example here showing a GBP-denominated ETF down minus 14% year-to-date, compared to just 8% for the index. This may seem concerning, but a stronger pound also increases your purchasing power, allowing you to buy more US assets for the same amount of GBP so you get more out of your next contribution. It's a silver lining that often goes unnoticed. Yes, the red number in your portfolio may be greater, but you can put that positive spin that the stronger pound does mean you can get more out of your next contribution. I want to reiterate, by the time you're watching this, the markets may look completely different, the tariff situation may be completely different. However, the key investing lessons remain consistent and timeless. As sensible investors, we often find comfort in confirmation bias, reaffirming our long-term strategies amidst short-term noise. So this video will most likely reaffirm what you've already heard. But in times like this, it is always good to have these reminders and remain sensible, not emotional. In summary, whilst the headlines may be alarming, understanding the broader context and maintaining a long-term perspective can be very helpful and help us all as investors get through these tougher times. And I strongly believe that once you get that long-term mindset and reassure yourself with the data, whilst there are never any guarantees, these sort of dips, crashes, corrections just don't even faze you anymore. And I can say with 100% certainty that is honestly how I feel. When I wake up and see the market's down or up, it honestly doesn't faze me because I know the day-to-day performance in the stock market is nothing I need to worry about as someone who's not trying to time the market. It's worth taking a step back and gaining some historical perspective. Market corrections, dips, and even severe crashes aren't rare. They happen quite often. They're most certainly a feature of stock market investing and not a bug. According to research from Bank of America Merrill Lynch, since 1930, the S&P 500 has experienced a 10% pullback on average once per year and a 5% pullback about 3 times a year. Now, these averages are pulled up a little bit by the chaotic 1930s, but it really isn't an exaggeration to say pullbacks are completely normal and they happen all the time. More insightfully, even in years that end positively, we often see major declines along the way. There is no better example of this than the 2020 COVID stock market crash. After lockdowns were announced, the market nosedived minus 37%. But by the end of the year, the S&P 500 had posted a 16% gain. That is an amazing swing and a perfect example of how unpredictable the market is. The average calendar year since 1980 has included an intra-year decline of around minus 14%. And yet in 30 of the last 40 years, that's 75% of the time, the market still finished in the green, up. So yes, even in years where you ultimately end with your portfolio being up, the ride can be stomach churning, seeing huge swings along the way, and the market really makes you work for that equity risk premium. It's called a risk premium for a reason. No pain, no gain. So we've established these pullbacks are normal and even happen in positive years, but now we should also remind ourselves of the historic returns of global stock markets, even in despite of wars, financial crises, political upheavals, and pandemic. Whilst we should always remember that past performance does not guarantee future results, the amount of terrible situations the market has recovered from historically should act as some form of reassurance. There's much worse things that have happened in the world than some tariffs. Since 1970, global equities have returned around 10% per year on average. And looking at a chart, it is clear the direction of the market has always been upwards. You can also see that the recent Trump crash, if we can even call it that at the moment with the recovery, it does look like a minor blip. And in the future, it is likely, but of course not guaranteed, that this blip will be incredibly insignificant. The reason why it is so hard to stay on track, despite all this historic data and reassurance, is that we're surrounded by so much panic and so much doom. Let's be honest, market crashes make for great YouTube thumbnails and dramatic news stories. I'm guilty of that too sometimes, but I'd hope you agree that the content is sensible. Not everyone on social media is sensible though, and many will have you doubting yourselves. There's loads of social media gurus telling you that they've gone to cash, that they've gone to gold, that they've timed the market and they'll know when to get back in, they're sitting on the sidelines, as well as reminding you that if you're still in the market, then you're the fool. Trying to time the market based on fear or headlines might feel smart in the moment. After all, why would you want to be in the stocks when there's so much uncertainty? But history tells us that it's usually a losing game. The longer you stay invested, the more predictable your returns become. Before we dive further into the dangers of timing the market, I want to take a quick moment to thank the sponsor of today's video, XTB. XTB are a recent entrant in the stocks and shares ISA space in the UK, and it's great to see a super competitive offering. It's free to open an account and they offer zero commission on stocks and ETFs, and with over 4,500 to choose from, you really are spoilt for choice. Their ISA is also flexible, so you can withdraw flexibly without impacting your annual allowance. On topic for today's video, they also have investment plans which are perfect for long-term investing. You can set up your investments and set up an automated recurring payment to go into them, perfect for hands-off, no timing of the markets, and a long-term approach. Also, they're currently offering an incredible boosted 6.5% AER on your free funds held in your ISA for the first 90 days. This is made up of their 4.5% AER variable rate and a 2% AER boost. So even once the boost is gone, the standard rate is very competitive. You can claim this boosted rate offer by creating an account before the 30th of April, and you can find the link to XTB in the description below. Thanks again to XTB for sponsoring today's video. I've been getting many smug comments recently from those stating that the crash was obvious and that they're in cash or in gold and they're just going to wait before they enter the market when things look better. That sounds great, but the reality is that timing the market consistently is close to impossible. You may get lucky with your exit point, but how will you know when to get back in? There's no green light at the bottom telling you to get back in, And especially when you've got an orange president flip-flopping all the time, the bottom is incredibly unpredictable. There's only two ways you can time the market consistently: insider trading and a crystal ball. One will end up with you being in jail, and the other, well, it's imaginary. So you get my idea. It's just not going to happen. You're not going to time the market consistently. To be clear, the thing that makes timing the market so difficult is that it requires two successful decisions. You need to know when to exit, and then you also need to know when to re-enter. Two very big decisions. This can be referred to as reinvestment risk. Getting your reinvestment timing wrong can hurt an investor badly and massively reduce their lifetime returns. That is because some of the best days in the stock market often come immediately after the worst. If you're out of the market on those best days, your long-term returns take a serious hit. Just recently, on the 9th of April 2025, we saw one of the top 10 best daily gains in the S&P 500 history, ranked 8th in fact. And if we look at this list of largest daily percentage gains and daily percentage losses for the S&P 500, you'll see the pattern of often worst and bad days being in the same year. 2020 is once again a great example of this. You can see that it features in the 3rd and 6th worst days for the S&P 500, but it also features in rank 10 and 11 on largest daily percentage gains as well. Fear was absolutely rife then, and I can only imagine how many investors got stung by switching to cash out of fear and then failing to get back in before the stock market rallied, selling low and buying high. That's a potential danger of market timing. Meanwhile, those who stuck it out and remained invested certainly are looking back and happy with themselves right now. And to quickly cover this, no, technical indicators probably won't help you time the market. The MACD seems to be the latest trend I hear a lot of people talking about and using to time their entry and exits, but it's a lagging indicator. It sort of tells you what's already happened. The signal line has crossed and you want to buy back in? Well, great, but Trump's tweet pausing the tariffs and a 10% surge was yesterday. You've missed the boat. I really am a big fan of the saying that technical indicators are astrology for finance bros. Put simply, most long-term investors are usually far better off ignoring the noise, staying the course, and letting time do the heavy lifting. It really is that boring. It's not exciting at all, but it has historically always worked. There's no need to stress about timing things perfectly, or you don't need to pretend that you can predict things by looking at a chart with pretty candles. Let's finish off by talking about arguably the biggest risk to your long-term investing success, or in my case, me. And we're going to finish how I started basically. Even if you've heard everything that I've said before, and let's be honest, you probably have, confirmation bias when it comes to sensible long-term investing is not a bad thing in my opinion, and help us manage these annoying emotions of ours that are telling us to sell, telling us to buy, and try time the market in general. The truth is, we're often our own worst enemies. We always want to tweak, we always want to make sure we're getting the best price, selling and missing the crash. You could say we let fear take over during downturns and greed take over when the stock market is rallying to all-time highs. We want to sell when things go down, but don't want to sell when things are going up for ages and valuations look ridiculous. Make it make sense. That's why studies consistently show that the average investor underperforms the market. It's not because of fees, it's because of their behavior and decisions. With hindsight, we can see that pretty much every crash or correction so far has turned out to be an incredible buying opportunity if we're investing for the long term, and especially for those with 10+ year time horizons. It's important to remember that these dips and crashes aren't just a frustrating side effect of stock market investing, they're the whole reason we're rewarded with these higher returns. Once again, it's the equity risk premium. No risk, no reward. Another way of challenging your emotions is to ask yourself, if you were happy to top up your ISA or SIP at all-time highs, then why are you hesitant when stocks are a bit cheaper and you're getting more out of your contribution? It is strange how reluctant we can sometimes be to continue investing given this framing. And also to quickly mention, as I know some people might comment about this, if you're approaching or in retirement, you can still invest confidently too, as long as you have the right plan in place. I personally like the bucket method that Ian Shadrach talks about a lot on his channel, where you have a bucket of cash or cash-like investments for the short term, maybe 3 years, and then you have a separate bucket for medium and long term, and with those medium and long term buckets, you can have the more risky 100% equity funds, global funds, thematic funds, whatever you want. And because you have that short-term bucket, you can ride out the fluctuations in your medium and long-term bucket because that cash bucket is there, remaining stable, and you don't need to stress about what's going on in those long-term buckets. Of course, retirement planning is complex, and I don't pretend to have all the answers. It's just the bucket method is one way you could potentially feel a bit more confident in stock market downturns. At the end of the day, long-term investing has historically always worked, but only if you can stop yourself acting irrationally. Staying consistent, patient, and trusting the process is key. So to conclude, markets are noisy, crashes can be scary, and there's no skill involved in timing things perfectly, no matter what gurus tell you. Where does skill come into knowing what Trump will do? If there's one thing that history has shown us time and time again, it's that staying calm and staying invested beats panic and prediction every single time. To quote Morgan Housel, the author of The Psychology of Money, every past market crash looks like an opportunity, but every future one looks like a risk. So how are you going to see this downturn? An opportunity or a risk? Let me know in the comments below.